If you're a New Zealander or Australian living, working, or freelancing in the UK, grab a bicky and settle in, because April 2025 is bringing the biggest UK tax shake-up we've seen in decades. But don't panic, it's not all bad. It just means it's time to get your financial ducks in a row before HMRC starts asking awkward questions about your Bondi flat or your NZ shares. First up, say goodbye to that handy little £2,000 exemption. You know, the one that let you quietly ignore small bits of overseas income? Gone. From April 2025, every dollar from dividend to rent needs to be reported, even if it's still chilling in your Aussie bank account and hasn't so much as glanced at Heathrow. So if you've got a rental ticking over back home or a savings account earning interest in New Zealand, you'll now need to pop that info onto your UK tax return. Don't worry though, thanks to double tax agreements, you won't be taxed twice. You'll just need to do a bit more admin. Think of it as the adulting part of being an international jet setter. Now let's talk about the end of non-dom status. For years, this let you choose how foreign income was taxed. Ideal if your overseas finances were bubbling away quietly while you worked in the UK. But from 2025, that option's off the table. The UK is moving to a residence-based system. Live here equals taxed here. Simple. But not necessarily a bad thing. It makes the rules more predictable, and if your income structure's fairly straightforward, you might not even feel the pinch, especially if you've already been declaring most of your earnings anyway. Newcomers to the UK? You get a little treat. The new Foreign Income and Gains (FIG) regime gives you a 4-year window where you might be able to exclude overseas income from UK tax. Nice, right? Just note, you'll give up your UK personal allowance in return. So, depending on your mix of income, the FIG deal may or may not be worth it. Worth running the numbers before jumping in. Then there's inheritance tax. Not usually front of mind for most of us, but the rules are changing here too. If you've been in the UK for 10 of the past 20 years, HMRC will now consider your entire global estate part of the inheritance tax picture. Yes, even your house back in Melbourne or those family shares in Christchurch. The kicker? These rules can follow you for up to 10 years after you leave the UK. Basically, it's the tax version of a long-distance relationship. It's not a trap, it's just time for a little life admin. Check your residency, round up your overseas income, ditch those dusty old investments, keeps you ahead of the changes and out of HMRC's inbox. So, if you want to keep that no worries vibe alive, better start planning now before April turns into an expensive surprise party hosted by your least favourite guest, HMRC. And remember, with no worries, you will always have someone who can help translate IRD into HMRC.